Hello, good afternoon. Please take your seats if you may. And first of all, a big thank you to Capital Link for giving me this chance to moderate what is bound to be a very interesting and lively panel discussion. And just before I introduce our esteemed panelists, I would just have a quick introduction about myself. My name is Elton Chan. I'm a partner at Stephenson Harwood, Hong Kong. I'm practice in ship finance, including senior debt leasing and various different solutions. In terms of experience, I started working in this area in 2006, so coming up 19 years now. Time just does fly when you get busy, and of course now we're in November, approaching year end. There's the usual pre-Christmas crunch, as we would say it. So with that in mind, there's no better time than now to sit down and share wisdom and learn from each other, and especially in this regard, I'm very pleased to introduce our list of panelists. So I will just go by alphabetical order, by surname. So in this case, I would like to introduce first Ms. Emma Cawood from Cetus Maritime, which really doesn't need much introduction. One of the biggest Hong Kong headquartered, Hong Kong managed ship owners, covering a wide sector, bulk carriers. And of course, in case you've been living under a rock, Cetus has been very active, not only in traditional sort of ship owning and financing, but of course in M&A as well, with the acquisition of HCB a few years back. And we, of course, work with Cetus quite a lot as well. And in fact, on a wider sort of context, it's almost like Capital Link knew who we knew and put this panel together, because basically every institution represented here have been working with SH for a number of years, certainly since I joined anyway. So again, we're very, very lucky to have this panel. And so moving along, we have Mr. Gautam Khurana from Precious Shipping, of course, one of the largest Southeast Asia headquartered shipping company listed on the Thailand Stock Exchange. And of course, again, I have the privilege of working directly with Gautam on a number of senior debt financings. So, and of course, we also were in the same panel in Capital Link Shanghai exactly, I think, 14 months ago in September 2024. So it's good to see familiar faces. And then next, we have Mr. Joachim Jaeger, Skorge, sorry, from DNB. Again, DNB doesn't need much introduction when it comes to ship finance, because DNB would know everything there is to know about ship finance in terms of solutions, market trend, what's maybe not so popular, what's the trend. So again, I personally am looking forward to learning from Joachim. And of course, last but by no means the least, Ms. Samantha Xu from BW one of the largest LPG operators in this part of the world. And again, SH know them very, very well. We've worked together for many, many years. So a very, very illustrious panel. And again, I'm very fortunate to have this opportunity to help moderate. And when I say moderate, it's basically me learning from our guests today, and by asking, what I believe, hopefully, interesting questions. And just one disclaimer: none of these questions are written by AI. Okay, I actually thought about them myself based on what I knew, however very little, but at least these are not generated by machines. So, with that in mind, I would like to start with Emma. So back in June, again, as I just goes to show how well we know our companies know each other well. Emma was in North Shipping, also on the panel moderated by our global head of ship finance, basically my boss's boss, Ian Mays. And at the time, even now, I would say there is basically no escape in not talking about the US-China relationship. And of course, in North Shipping, you can imagine the context and the sentiments a bit different from where we are in Hong Kong now. And nonetheless, at the time, we knew the 301 investigation was well underway, and then we knew the extra port fee / tariff / however you like to call it were to come into effect in October, November this year. That was, of course, at the time, the sentiment and the panel discussion was that Cetus at the time would, like most sensible ship owners, would adopt a wait and see approach, because things change very quickly. And if anything we've learned in the past, say 5-10 years, is the only constant in life is change. And it is cliche, but it's very, very true. in the maritime sector, whether you're financing your operator or bunker supplier or broker or other professional service providers. One tweet from President Trump on Truth Social, and suddenly you have this volatility in the market, and then another meeting, another phone call later, things seem to be okay. So with that in mind, after what we witnessed between President Trump and President Xi in Kuala Lumpur, things seem to have quieted down a little bit. And so on that note, may I just ask, what is, coming from a ship owner's perspective, is the approach still wait and see, or do you think that there are things on the side, maybe compared to your industry peers, that maybe Cetus could do?
Thanks, Elton. So I think we actually took the right approach by taking a wait and see angle. That doesn't mean that we weren't preparing in the background. We definitely came up with a mitigation plan. That was less so around our financing, given that only 5% of our fleet was or is financed via Chinese leasing structures. So not enough of a material number to make us too concerned. But we did have more concerns around our corporate holding structure. So we did develop a mitigation plan around that, which we did execute rather slowly, which I'm glad we did now. We didn't want to have a knee-jerk reaction like some of our contemporaries. That plan is still underway. We will still continue to execute it, but with a lot less urgency given the developments over the last few weeks. Given we do have such a diverse funding base, really the concerns are not really focused on the Chinese leasing for us at the moment, but I would say that we would not likely enter into any new structures with immediate urgency. I think overall the overarching issue with USTR, which we've all talked about until we're blue in the face this year, quite frankly, is that this uncertainty has been very detrimental to our industry in terms of financing, in terms of S&P, in terms of opportunity. So I think we can already see with the year-long delay that opportunities are bubbling up to the surface before the end of the year, which I think is a positive for all of us overall.
Thank you, Emma. And indeed, Cetus is very much known for its being pragmatic and being practical, not putting every egg in one basket, as again, any sensible owners and operators would do. And of course, you mentioned PLC leasing, which is of course, it used to be, it's funny, it wasn't that long ago, it used to be called alternative, but of course now it's as mainstream as it comes. And our firm, of course, and our peers in other law firms has jurisdictions across Asia and also in Europe as well. We've also done many ship leasing transactions. But then you did mention that there is a potential of ownership issue and construction issue. I think that everybody accepts that, because with the Chinese shipbuilding capacity, there's just no going around the fact that it's very difficult to never order a ship in China, despite what USTR may do. Again, they may flip a switch next year. We go back to the negotiations and sort of the conflicts again. So with that in mind, you did mention maybe Chinese leasing. There's an issue there. Do you think some other players coming in to trying to build a void again? For example, private credit is sort of like this zing word now these days.
So looking forward, I mean, really it's about where the company is, what the company needs the funds for, but really it's about where the market is. And I think as ship owners at the moment, we're in a very beneficial position for once, where we can dictate terms more than we have so in the past. Since I joined Cetus 5 years ago, we've really kind of touched on every kind of financing available, alternative financing to access opportunities very quickly, Chinese leasing to have very high LTVs and long amortization profiles to help with our break-evens and downturns in the market, JOLCOs where we want high LTVs and very low margins. But what I will say is the constant for us has been traditional bank debt, and that is, given where we are as a company now, an avenue that we will continue to pursue again. I think, the banks are coming to ship owners with more flexible terms than they have in the past. I'm sure Joachim will sell the public market offering to you very soon. Again, that is appealing, and we have looked at it in detail. It would be great from a cash break-even perspective, but maybe not necessarily for us right now for a pricing perspective, unless Joachim can deliver on that for us. But for us at Cetus, our financing strategy is really around agility. So we're looking for flexibility, and we're looking for financiers that won't enter and exit the market. So with that being said, I think, I can safely say we're looking forward to longer term partners over the next few years.
Thank you, Emma. And again, just from personal perspective, as legal service provider, we do have the privilege again to see a wide spectrum of transactions from different players. So different banks, different leasing companies, different owners, how they think. And a lot of times pricing, of course, is a big one. Same with our legal fees, of course. But at the same time, there is still, Emma did touch on the fact that there's agility is a big one. Flexibility is a second one, but also commitment as well. We've seen cycles whereby this is, again, I would say the second or third cycle, but the first cycle that I saw personally was when Lehman collapsed. So I qualified in 2008, which is literally into banking finance. Couldn't be worse timing, because I remember 3 weeks before I finished my training contract, Lehman Brothers went down, and my old firm at the time actually did a lot of work for RBS ship finance. So you can imagine, it was quite depressing. Some partners quite literally lost their book overnight, because they were doing HBOS and RBS ship finance lending, and just suddenly gone. Same for partners who used to act for, say, ABN and Fortis. So there was a lot of change, and then the feedback from the borrower side is of course, what happens. Suddenly you think you've worked with a banker for 5-10 years, and suddenly they decided to sell the whole portfolio, and you're dealing with a hedge fund or some kind of potential, unknown entity that may or may not share the same sentiment or commitment to the sector, and they come in, look for a quick kill, even worse, sell down even further, and then you into quite uncharted waters, pun fully intended. So with that in mind, I will move on to Gautam, and in fact, this is one of the conversations we spoke about, not during the panel in Shanghai, but when we were sitting at the crowd and we had just having a casual discussion about basically your background, which is before you joined Pressure Shipping. One of the phenomena happened to you was one of your I wouldn't say which one, but the one of the banks dealt with decided to basically exit the sector, and then suddenly you're facing with uncertainties. But coming back to where we are now, and again, when we were in Shanghai during a panel, you said you had some good experience with Chinese financing solutions, mainly ship leasing. Again, because of what Emma mentioned, the clear, obvious attractiveness about high LTV, dealing with bilateral, just one lender basically, so you don't have to go through the agent and talk to all those syndicates or get majority voting and so on and so forth. So fast forward to today, again, a lot happened in 14 months, we already talked about. Do you think your calculus has changed in terms of the sort of geopolitical situation? Again, Emma mentioned, we talked about, everyone has been talking about USTR until the faces are blue, but still it's one of those unavoidable things. So for example, when you negotiate with your financiers, are there any particular terms, conditions, or counterparty considerations that you would not have considered 14 months ago, but are very important to you now, please?
So yes, when USTR was imposed, it was certainly a concern, and we were discussing some Chinese leasing transactions, which we stalled at the time. But I think the China imposing counter penalties on US owners and operators, in my mind, changed everything. Why? Because China is really what drives, has a much bigger impact, I would say, on shipping demand, on our sector, in particular in dry bulk. I think more than 45% of demand is from China, a very small percentage from the US. But if you look overall as well, China is at 32%, the US is maybe at 12%. So clearly, if China imposes penalties on US operators and owners, the impact would be much greater on US entities. And so my prediction at that time, when China decided to impose these penalties on US owners and operators, was that within 3 months, USTR will go away. But I was wrong, because it went away in 2 weeks. So we are very happily working on, we restarted our discussions with some of the leasing houses that we were working on transactions with. And so that's definitely a source of capital that we will be looking to tap into in the future.
Thank you. And perhaps this is, again, more maybe for Joachim later on, but when it comes to more innovative financing options? Because again, you being a public listed company, would you perhaps wish to see at least an offering, maybe a discussion on something more sort of innovative / exotic? So, for example, one of the big ones we've seen in other sectors, project finance, I think is quite popular with things like sustainability linked bond, for example. Would it be something that would be attractive to you? Again, bearing in mind your profile as a public company.
So we've actually done both. So we were actually, in fact, the first Asian shipping company to issue a sustainability-linked bond. And the benefit over there was that we were able to issue a bond for a 10-year tenor, which we would not have been able to do had it not been a sustainability-linked bond. So, quite valuable. Also, actually, project finance as well. So we have traditionally, I think, ship finance is asset finance based, but we've also done financings within the last 5 years, which have been, very much project cash flow related sort of financing. So we've tapped that. Now, what else we would like to see? So we've been offered receivable financing, but receivable financing, the terms that we've been offered haven't been attractive enough for us to be able to go in for that. But certainly, I think if the terms improve, we would certainly consider that.
Thank you. And speaking of financing solutions, of course, I would like to move on to Joachim now. Now, as of course, DNB, everybody knows you're one of the market-leading financial institution when it comes to maritime sector and providing various solutions. And you obviously, again, see a wide spectrum, a very unique vantage point on, global capital flows and trends. So a key question on everybody's mind is, we mentioned, PRC leasing, again, is inevitable. But assuming, personally, I haven't seen a slowdown yet, both new deals and restructurings or repaperings for various commercial factors. But assuming there is a slowdown, which is a big assumption, do you anticipate, because the funding, the portfolio size is so huge with so many, I think the last time they counted, there probably is somewhere between 30 to 40 Chinese leasing houses, 30 to 40, somewhere between that. And there may be new ones coming up as we speak as well. So there's a massive portfolio there, both onshore and offshore. So RMB and USD and euros and whatnot. Do you think a strong comeback from sort of traditional quote unquote European banks and institutions to fill that gap? If not, then again, private credit, again, personally, I'm never quite sure what it means, private credit. Are they PE houses? Are they just rich family office who happens to have feel 100 billion willing to lend? So please, I would be very much like to hear your insight.
No, first of all, I think Chinese leasing is probably here to stay. So that's my working assumption. I do think going forward, we'll probably see companies tapping into a very diversified set of funding opportunities. I do think that we also see other non-Chinese leasing houses being more active at the moment, and some of them are being established as we speak. So that would probably fill some of the gap. I think when it comes to European banks, if you look at the numbers over the last 15 years, they've roughly reduced their portfolio with about one third compared to 15 years ago. I think the European banks will continue to be active, typically towards the most creditworthy and larger clients, which have a lot of funding options in today's market. But then I think there will also be other alternatives like private credit, which you mentioned. I think also the bond market is really growing very quickly now for shipping companies. Sorry, Emma, I had to mention it. So we've seen, especially in the Nordic market, a lot of companies that traditionally wouldn't go to the bond market, doing both secured bonds, unsecured bonds, getting very attractive terms, in the mid to high single digits. And that is also emerging as a very attractive funding source. I don't think it's something that will replace bank financing, but it's something to complement bank financing and also lease financing. So I think there's multiple sort of factors at play here. I think also one thing to remember is that the equity portion, in ships is much higher than we saw a few years back. Obviously, vessels are also more expensive. But we also see a lot of our clients operate with relatively low leverage compared to what we've seen in shipping historically. That's also something to keep in mind.
Yeah, thank you. And it's just well, you touched on the point about potential sort of quote unquote flight to quality, because what we've seen on the sort of papering side is we see a lot of term sheets coming through, and sometimes we lawyers, we do get a bit numb or just numbers because we focus on the structure, the risk, documentation, and also the process. But then sometimes when we take a step back, we do realize, and then first thing we realize, oh, it's always, I wouldn't say the same couple of names, but there's a very familiar core of very big name institutions, whether direct lending or would be leasing. And so this flight to quality, because on the one hand, you have risk departments and credit departments saying, oh, let's be safe and reduce the risk. But then what happens, what we do see is that you have this same massive conglomerates who have very easy access to a lot of very, very competitive priced financing products. But then at the other end, not even at the end of the spectrum, but if you move sort of towards in the middle a little bit, the not so quote unquote big players then suddenly find themselves facing terms that are much more different. So you have this, but then in a way, it is expected because there's a risk, and credit department always, of course, have this eternal struggle with the frontline relationship managers who wishes to have their own KPIs, want to make the deal happen. So with that in mind, with that mindset, how do you structure your products to make sure that it's a fair offering to different products for different customers, basically?
Well, I think, our approach is that, we do investment banking and corporate banking together. I think our corporate banking product is typically focused on, again, larger, more creditworthy clients. That's our strategy, and a lot of other European banks have the same strategy. So I don't think that's entirely unique. When it comes to investment banking, we have a much more flexible strategy where we can typically work with any maritime company, even if it's a young company, smaller company, if they want to have more leverage, compared to what we would be dealing with on the corporate banking side. So on that side, we're very flexible in terms of finding innovative financing solutions for our clients. It could be leasing, it could be private credit, it could be bonds, it could be a combination. So we have a lot of flexibility on that side. I think also when it comes to our larger clients, we like to, as many banks, cross-sell. So we have invested a lot in our investment banking platform, where we have, very strong placing on the global league tables when it comes to M&A, bonds, and equities. So we like to also offer that platform. Sometimes we offer that platform without any lending relationship whatsoever, but sometimes we also combine having a lending relationship and offering that investment banking platform. But I think it's important for us that we have an investment banking platform that is strong enough to be compelling, without the balance sheets. So that's really what we tried to build, and something we invested very heavily into over the last few decades, actually.
Thank you. And Samantha, thank you for your patience. In your Lloyd's List interview in September this year, you mentioned the 3 key factors driving LPG shipping. So location of demand hubs, locations of supply hubs, and of course, issues around Panama Canal. And of course, we saw during COVID how one sideway cargo ship could, have ripple effects across the world. So notwithstanding this, though, do you believe that lenders and investors will look at the LPG sector, given its critical role in the energy transition? It's like a safe haven compared to, say, other segments, such that, and also does it translate into generally better financing terms?
Well, I guess it's a yes and no question answer for that matter. I think one thing for sure in the shipping is that nothing's constant. And as we have obvious that post-COVID, there was a wave of time that there is no discussion about traditional hydrocarbon, and the sustainability renewable energy is the key and critical topics to be discussed. At that time, we also was in the center of discussion with all our banks is that it's still gas bankable for you. Right? Luckily, is that as we see right now, not only is bankable, but also LPG, for example, is considered play a key and critical role in the energy transition. Not only that, when we look at energy transition, very much is on the
marine fuel transportation, alternative, etc. But as a LPG, it also play a very important role for the developing country economies where people who are still using biomass as the heating and cooking source. It's a fantastic replacement as a cooking fuel. And also for the like of, for example, for all of you and all of us, day-to-day basis, we enjoy the benefit of LPG as a feedstock, right? Where the automobile, the construction, and all the industries that impacts our day-to-day life is because LPG as a feedstock in the petrochemical industry. So I think we now, the industry all recognize that LPG is an indisposable factor in our life. But does it cause for better premium? I would say no. It takes a lot because all our banking partners, they are extremely diligent. They want to make sure that not only the business fundamentals is good, but also that their client is of a good stand. For example, they are the ones that are worth a fantastic corporate cultural corporate value, the ones that worth a heritage, the ones that has in the history that prove that there's is worth it to be partnered with. So I think that's very important for us to continuously go to our partners, tell our stories, share with them how we do, how we conduct our business, carry out our risk management, as well as align with them with our strategy as well. So,
thank you. And in fact, I remember before COVID 2019, of course, the last Marine Money I went before we went into sort of pause it. The talk was all about decarbonization, and even the first Marine Money and other similar forums. After COVID, when Hong Kong happened, the talk was still very much about decarbonization. And then at some point, and this is a true story, our internal, we have a practice group talk about decarbonization. We realized we shouldn't focus on the word carbon because exactly what Samantha mentioned, there is still a massive critical demand for just sort of traditional petrochemical, sort of the less clean, if you will, because there's a stigma about, you talk about oil and gas. It was almost like, for the period of time, it was almost taboo. But so we realized we should use the term energy transition. And I think that's in most firms, and marketing material, we talk about energy transition rather than decarbonization. And along those lines, and during the introduction segment, I mentioned that BW, of course, has a very unique position, being dual listed in Oslo and New York. And in that regard, so how are you leveraging these two different pools of institutional capital? Because both are huge capital markets, one in Europe, one in the US, and there's a lot of funding, a lot of different solutions, different investors, different sentiments. So do you see a divergence in the investor appetite in these markets, valuation, for example, and how does that influence your decision making for future capital raises, whether it's for new buildings or, say, renewals?
Yeah, thanks, Elton. I think we were very lucky. We have been, first of all, we have been listing Oslo Stock Exchange since 2013. The current BWLPG is, merge and acquisition of the Hong Kong-based Worldwide back in time, as well as a Norway-based the Bergersen family. So from there, the inheritance we have, the connection that we have with the Norway-based investor community is extremely close. So if you ask the Norwegian investors, we are a household name. So there we don't have to market ourselves. We have a lot of trust of institutional investors, and then they will be there, ring or shine for us. And also, very importantly, is that they are the group of investors, with the North Sea at the backyard. They understand oil and gas of business and LPG as an associated gas, a byproduct of oil and gas production. So they understand the business. But however, compared with their US counterparts, they have a little bit of a different take in terms of the growth story of hydrocarbon. As we all see that there is a divergence in terms of how we take the ESG topic for European and US-based stakeholders, let's put it that way. And in US, you don't have to explain to them why, although the real count is not increasing, but the production will still increase. Because, again, this is also in their backyard, especially in the, they see the export terminals expanding their capacity on a daily basis. The oil and gas just keep pumping out because the productivity increase, etc. So from that perspective, we're very lucky, although a little bit different perspective. Both group of investors, they know the oil and gas business and hence know us as a business very well. When it comes to in the future, in terms of raising the capital, we will all get very much of a support over there. That's how we look at it. And also as a company listed in both of the market, we are compliant to issue equity in both of the market. I think when it comes to which market to choose and how, it very much depends on the project, where we can have a more alignment on the strategy perspective with different group of investor, the time to market, and also whether we will get sufficient sort of equity coverage as well in order to entice more investors' appetite. But definitely we see both markets plays very unique, same and different roles in that perspective.
Thank you, Samantha. And just in time, I think we have time for say 2 quick questions for everyone on the panel. We've touched upon some of the top points already, and again, it just goes to show the expertise on play in this panel. And I suppose the first question, which should be a generic one, it's with so many different options, financing solutions available from different sources that we briefly touched upon. I do wish we have more time. What are the key drivers, for example, as owners and customers, if you will, when it comes to assessing financing solutions? And again, it's open for everyone here.
Thanks, Elton. I'll start. So I think without repeating what I said earlier around flexibility, etc., a very key consideration for Cetus in recent years is ensuring that our financing reflects our sustainability goals. So we're looking to make our future financing sustainability linked. We performed a very large scale fleet renewal over the last few years. I think we bought and sold around 50 vessels net. We also performed 2 consolidations, which changed the makeup of our fleet. So following all of that hard work to bring our fleet up to the sustainability standards that the industry expects and demands of us, we want our financing to reflect the same. I think going forward, access to competitive capital is going to be contingent on showing the market that you are a sustainable company.
Thank you, Emma. Gautam, please.
Yeah, I think for us, the most important thing is relationship with the financier, number one. Number two, I would say, is the experience that the financiers have in the shipping industry. Last thing we want is a financier who panics if there's a downturn, and downturns are inevitable in shipping, as we know. Secondarily is terms. So I think relationship and experience is actually most important. And terms ranges from LTV to margin to long profiles. I mean, all of these things are, for me at least, secondary.
Yeah, from our perspective, we see that clients are obviously price sensitive, as you would imagine, but there's a lot of other things going on as well. Sometimes you work on complex M&A transactions and then working with an institution that can deliver on complex financing under an accelerated timetable and have predictability around financing. Also, who can maintain confidentiality is very important. I think also a lot of our clients are very focused on diversifying their funding sources. So it's not only about price; it's about having more optionality and being active in many markets in parallel. And then I think also more and more clients are looking beyond the usual toolbox. So I mentioned bonds, Nordic bonds in particular, which can also be seen as the replacement for equity, not only a replacement for debt. And there's a lot of interest in that also from this part of the world.
I think from our perspective, everything mentioned is important. I think depends on when priority changes. If I would mention that if you look at the current market right now, of course, one is flexibility, the other is pricing. Those are almost a hygiene factor, especially what banks have, abundance of capital, so other ship owners as well. One thing I would especially mention is that we wanted to work with banks who want to understand our business, take an interest in our business, because at the end of the day, what we look for is a partnership. So it's very important that by understanding the business, that they would travel with us through high and low.
Thank you. And I think we should have time just enough for one question, and the final one on my list anyway. Of course, please, we will try to have time for a question from the floor as well, if possible. We touched on it before. Of course, very familiar product in this world would be leasing and senior debts. What other solutions would you be particularly interested to see in this part of the world where it hasn't been done that much? For example, we mentioned bond, we mentioned equity raising, securitization, receivable financing, and possibly one thing that I learned from the aviation market years ago is the equity trust certificates. Maybe there's more North America. I'm not sure. So please, again, I would very much like to hear your thoughts, please.
Well, I think a financing instrument will pop up when there is a problem. Existing products cannot provide solution. So I'm not going to push for any instruments pop out of nowhere. And traditionally, aviation has been leading the financing instrument where there are a lot of similarities, and then become instrument that utilize the maritime industry. For such we welcome. For now, if you look at us, I think we value a traditional bank financing. It fulfills our needs. And we believe that Chinese leasing will be here to stay. The loan to value is very attractive. The margin as well. The JOCO, I think it's also a good financing tool, provided that you can manage the flexibility by finding a unique commercial solution.
Thanks. I would agree with Samantha. I don't think we're in a place where we need significantly alternative sources of capital out with the abundance that we have right now. I mean, the bank financing, the lease house financing. But I will speak to our experience with JOLCOs. I think there's potentially a reputation surrounding JOLCOs that they're very inflexible and, the terms are very rigid. But we actually found that in more recent years, the terms are more flexible and the pricing is incredibly competitive. So I think that's a structure, if companies haven't looked at it and their fleet size is sufficient, it's one worth tapping into.
No, I agree with everything that has been said. I think also if you look at the full toolbox, not only the toolbox that a standard shipping company is using today, there's already a lot of interesting products out there in Asia and beyond. I don't think necessarily it makes sense to sort of limit finance option to what's available in Asia. It's really a global market, and I think also companies in Asia approach it as such. I think when it comes to new innovative products, I think any product development is welcome, but I think there's also a history in shipping. When it gets too creative, too aggressive, doesn't usually end that well. So that's also something to keep in mind.
I would say I think senior debt is boring, but it's dependable and predictable. So we like it most. But that said, I think that what you talked about JOLCOs, I think JOLCOs is a good part. You should have some part of your financing mix in things like bonds and JOLCOs to mix it up and to lower your overall cost of financing.
Thank you. And with that in mind, we run out of time. And again, I would just like to invite everyone to please join me in thanking our panelists today. And thank you for listening. Thank you.